Hi everyone, I'm James. Welcome to my channel. A lot of investors believe that if you can understand the economy, you can invest successfully. So they spend time forecasting inflation, interest rate, GDP, and unemployment, trying to figure out where the world is heading next. Because the logic seems obvious. If you're right about the economy, investing should be easier. But in practice, macroeconomic forecasting is extremely difficult. And in this video, I want to explore a deeper idea. Even when an economic argument or thesis is logically valid, the real-world outcomes and the investing results can end up looking very different. A useful way to understand this is through a specific example. One of the more well-known recent ideas comes from a book, The Price of Tomorrow by Jeff Booth. In the book, Booth makes a clear and central claim. Technology is deflationary. His argument is simple. Technology improves productivity, reduces the cost of goods and services, and should naturally push prices lower over time. It sounds almost undeniable. And yet, in the years following the pandemic, we experienced one of the strongest inflationary surges in decades. So what does that mean? Was the idea wrong? Or does it reveal something more important? Even correct economic ideas are extremely difficult to turn into reliable forecasts, and even harder to turn into investment decisions. To understand why this matters, it's worth first unpacking what Booth actually means when he says technology is deflationary. At first glance, this idea actually makes a lot of sense. We see it everywhere. Video streaming has basically replaced physical media. Content is cheaper, instant, and you can access almost anything on demand. Cloud computing has done something similar behind the scenes. Companies don't need the same upfront infrastructure anymore, and they can scale without costs rising in the same way. AI is starting to do the same with knowledge work, taking tasks that used to require people and making them much cheaper to produce. And e-commerce has made prices more transparent and competition much more intense, which keeps putting pressure on margins. So at a practical level, it's hard to argue with this. Technology does seem to keep pushing costs down and making things more abundant. And that's what really makes Booth's idea so compelling. Because when you look at that in isolation, it feels obvious. But there's a crucial gap most investors miss. A correct observation is not the same as reliable forecast. And a forecast is not the same as an investable thesis. And that gap is where most investing mistakes happen. The problem is that the economy isn't driven by a single force. It's the interaction of multiple systems happening at the same time. Things like technological change, interest rates, government spending, energy prices, supply chains, demographics, and geopolitics. You can be right about a single factor and still completely wrong about how the economy turns out. And this is where investors often get trapped. They take one powerful idea, like technology is deflationary, and assume it must dominate everything else. But macro outcomes don't work like that. They are messy, delayed, and often contradictory. And nowhere is this more obvious than what is happening with AI. In the long run, AI is exactly what Booth's thesis would predict. It's fundamentally deflationary. It automates labor, reduces the cost of knowledge work, and scales intelligence at near zero marginal cost. In theory, that should push prices down across the economy. But today, the reality looks very different. Because we are currently in the build-out phase of AI, and that phase is actually inflationary. Training and deploying frontier models require massive physical infrastructure. Data centers, electricities, memory, cooling system, and GPUs. And we are already seeing bottlenecks emerge, especially in high bandwidth memory and advanced chips. So in practice, a deflationary technology is currently driving inflation in the physical economy. If you're planning to buy a gaming console, laptop, or phone anytime soon, let's just say your timing might not be ideal. Because the same chips powering AI systems are competing with consumer electronics for supply. So in the short term, AI doesn't look like a deflation machine. It looks like a capital-intensive industrial build-out. And that's the key point. Even if technology is deflationary over decades, the path there can be uneven, inflationary, and far less straightforward than it first appears. Now we move from forecasting to investing. Even if Jeff Booth's thesis turned out to be right over the 10 to 20-year horizon, the more important question is, how do we actually make money from that insight? Because investing requires more than being right. You need to be right about three things at once: the thesis, the timing, and how the market interprets both. Miss any one of them, and the outcome can fail, even if the idea eventually turns out to be correct. This is where macro-based investing starts to break down, because it assumes a clean link between being right about the economy and making money from it. But in reality, that link is much weaker. Warren Buffett takes the opposite approach. He doesn't build portfolios around macro forecasts. Instead, he focuses on individual businesses, how they make money, how resilient those earnings are, and how they compound over time. The key point is that these businesses don't depend on a specific inflation or deflation outcome to succeed. They are built to operate across different macro environments. And that's the real difference. Macro investing requires you to be right about multiple uncertain variables at the same time. Business investing only requires you to understand how a company creates and compounds value. So we come back to the core question. Even if Jeff Booth is right about the long-term direction of technology, does that actually help you to invest better today? And for most people, the honest answer is not really. Because consistent investing success doesn't come from correctly predicting the economy. It comes from understanding specific businesses deeply. And there's another reason macro forecasting struggles as a foundation for investing. Even the most sophisticated institutions in the world consistently get it wrong. If the Federal Reserve Chair, using the best data available, can describe inflation as transitory, right before one of the most persistent inflationary periods in decades, and if major investment banks with entire macro research teams are regularly revising their forecasts every few months, then the question becomes unavoidable. What are the chances that an individual investor can consistently forecast GDP, inflation, or unemployment better? The answer isn't that you will be wrong sometimes. It's that it isn't a reliable process to begin with. And that brings back to the core idea of this channel, focus investing. Instead of relying on macro prediction that even the best institutions struggle with, investors are far better served focusing on what they can actually understand: the underlying economics of individual businesses, how they make money, how durable those earnings are, whether they are pricing power, and whether they benefit from technological changes instead of being disrupted by it. Because unlike macro forecasts, these are things you can actually work through in a structured, repeatable way. And that's the irony. While most people are trying to predict the economy, the real edge often comes from something much simpler: just understanding a small number of businesses better than the market does. I hope you found this useful. Feel free to leave your comment below. Stay focused, everyone, and I'll see you next time.